Hey guys, the Fed just gave a serious recession warning. And on this video, I want to talk about it. The Fed just released their meeting minutes from their latest meeting. Now, they had a meeting back in May, early May. And at that meeting, when you read through those meeting minutes, it reveals the Federal Reserve expects us to have a recession by the end of this year. Now, that's pretty point blank in the meeting minutes, okay? There's no mixing of words. There's no mistake. That's what they said in the meeting. Now, you can read the meeting minutes for yourself if you want, but it's a very, very boring and dull and dry read. That's what I'm here for. That's what this video is for. I want to give you the highlights of that meeting so you don't have to spend your precious time reading those minutes. It's a 12-page document and you probably will be asleep by the time you finish reading it. Now, just to be clear, these meeting minutes come from the meeting that the Federal Open Market Committee has. The Federal Open Market Committee, or what we call the FOMC, they're a 12-member committee from the Federal Reserve that's made up of 7 people from the Federal Reserve's Board of Governors, and it's made up of the one Federal Reserve chair, which is the head of the New York Fed right now, that's Jerome Powell, and then the other 4 members are from the other 11 Federal Reserve districts. So that's what makes up the FOMC, and they hold 8 regularly scheduled meetings every single year, and at these meetings, the FOMC reviews all of the economic data that they have regarding the economic conditions in the U.S., the economic conditions abroad that affect the U.S., right? Because they're looking at any applicable foreign things that's going on outside the U.S. They also look at all of the financial conditions, GDP, inflation, labor market. All those things put together are the things they use to determine at these meetings what the monetary policy is going to be moving forward. Are they going to raise the federal funds rate? Are they going to decrease the federal funds rate? Are they going to leave it the same? They look at all of the risk to their long-term goals of price stability, maximum employment, and all of their long-term goals. All the risks that are associated with all that, they put all that information together to come up with monetary policy moving forward and what they're going to do with the federal funds rate. Now, the federal funds rate simply refers to the target interest rate range, and it's usually a range. Right now, it's between 5 and 5.25%. But it's the targeted interest rate range that banks charge one another, commercial banks charge each other for overnight lending and overnight borrowing of their excess reserves. So with that said, guys, let me give you the highlights from the meeting. The one thing they talked about quite a bit was the GDP, the gross domestic product, the monetary measure of all of the final goods and services produced in a country over a set time. And typically that time, when we're talking about the GDP, that time is quarters. We measure it in quarters. Quarter 1, quarter 2, quarter 3, quarter 4 of each year. And so the GDP was a big piece of what they talked about at their last meeting. They mentioned the fact that the GDP expanded modestly in the first quarter of this year, but they did notice that there was a little bit of slowing of the GDP, right? Still going up, but not going up at a fast pace. And based on the minutes, they think that this slowing of the increase in the GDP is going to be impactful later this year. In quarter 3 and quarter 4 and into quarter 1 of next year, they're expecting GDP to not grow at all. In fact, that's when they're expecting the recession to happen. Remember, a recession is just 2 straight down quarters of a GDP. When GDP is going down for 2 straight quarters. That's the textbook version of a recession. And that's what they're referring to when they say that we're going to have a recession. They're referring to the 2 quarters that they're expecting, either 3rd and 4th quarter this year or 4th quarter and 1st quarter of next year when we're going to see a recession. Another thing they talked about quite a bit in the meeting minutes was the banks. What's happening with the bank crisis, right? What's going on with banks? How are banks handling loans? And what is the policy happening in banks right now based on some of the banking crisis that we've seen with several banks being taken over by other bigger banks? What they talked about was the fact that most banks in large, medium, and small, most banks in general throughout the United States is reporting some further tightening of their lending standards. So over the past 3 months, most banks in America have sort of tightened up their loans and loan categories. In other words, it's harder right now for individuals and for businesses to actually get loans. And they mentioned that these lending strategies being tightened up are going to continue through the end of this year. Now, when lending tightens up, there's going to be a further strain put on spending. Because, hey, if I'm an individual or a business and I want to go out and get money from a bank, and now it's harder for me to get money from a bank, harder for me to get a loan from the bank, I'm not going to be spending as much money. Now, when I'm not spending as much money because I can't get a loan from the bank because the bank now has tighter lending policies, then guess what? That means overall spending in the overall economy is going to take a hit. And again, that lends credibility to what they're saying also in the meeting minutes, that there's going to be a recession. Because when you couple banks being more tighter with their loans and not giving out as many loans, when you couple that with the Federal Reserve actually raising rates, making money and borrowing money more expensive, all of those things together is putting a tightening on the economy. It's saying, hey, guys, you got to stop spending money. We're going to have you stop spending money because banks are not lending you the same amount of money that they were before. And we're making the cost of money more expensive because we're raising short-term interest rates. So all of that together is saying, hey, there's going to be a recession. And they talked about these banks quite a bit in the meeting minutes. Now, let me just quote something from the meeting minutes. And I just want to read exactly what was said by the FOMC at their meeting. They said that tighter credit conditions for households and businesses were likely to weigh on economic activity, hiring, and inflation. So in other words, what that means, guys, is tighter bank restrictions on loans means that economic activity is going to take a hit. It means that even hiring for businesses is going to take a hit. And it means that inflation is going to also be affected by what the banks are doing in terms of these tighter lending policies. So the Fed, based on their meeting minutes, they're following what the banks are doing very, very closely. Now, speaking of the overall economy, these meeting minutes also pointed to the fact that the FOMC believes that the real GDP is going to decelerate over the next 6 months, over the next 2 quarters, before declining modestly in both the fourth quarter of this year and the first quarter of next year. So they're looking for this decline, but it's taken a while, right? Because there's some lag time that's involved here. Now, let's talk specifically about what the meeting minutes said about inflation. The CPI remained elevated just this past March, but continues to slow. However, on the other hand, the core PCE inflation, which is the one that the Fed looks at even closer than the CPI, and the reason they do that is because the core PCE, it excludes energy and it excludes food. Those things go up and down and fluctuate. The core PCE, therefore, is a broader and a more accurate view of what's happening on the overall picture in terms of prices going up. So the Fed really looks at the core PCE more than the CPI. The core PCE inflation is hovering around 4.6%. A few months back, 3, 4, 5 months back, it was 4.7, 4.8% mark. So the core PCE is being a little more sticky and it's taking longer to come down than, of course, the CPI. So the core PCE is only slightly lower than it was several months ago. It remains stubborn and it remains slow to go down to their targeted 2% inflation rate. So overall, guys, in the meeting minutes, it said that inflation is going down, but it's going down very, very slow. Slower than what they predicted. Now, they also talked about the labor market, which is a really big piece. They said, as we all know, the labor market remains very, very tight as job gains over the last several months have been pretty robust, right? I've talked about this in several other videos, guys. The amount of new non-farm jobs over the past several months remains pretty high. And at the same time, the unemployment rate remains very, very low. We're talking 50-year lows at 3.4%. So they made note of all of this at their meeting. But they also said that they do see some softening of the job market coming up soon. And they also pointed to the fact that they believe that these current Fed policies are actually ultimately going to have an effect on the labor market that they want to see happen, which is basically a loosening up of the labor market. In other words, they want to see more of a balance between the demand for workers and the supply of workers. Right now, guys, the demand for workers is high. There's a huge demand for laborers, for workers. But the actual supply of people out there to get these jobs is low, right? There's a lot of jobs. There's not enough people to fill the jobs, right? So what they want to see is this to come in more balance. And the indicator right now that we're out of balance between the demand for laborers and the supply of laborers is because of the low unemployment rate. Unemployment at a 50-year low at 3.4% tells us that there's more jobs, more demand for jobs than there are actual workers out there to fill those jobs. Now, there's another meeting coming up in just a couple of weeks, guys. June 13th and 14th is when they have their two-day meetings. At the end of that June 14th meeting, that's when the Fed Chair Jerome Powell addresses the media and tells us what they plan to do in terms of the federal funds rate. Now, what the Fed decides to do at this next meeting is going to be critical. What we've seen lately, guys, as you guys may know, is the stock market has been doing pretty well the last few weeks. But if we get news that the Federal Reserve is going to increase the rate, the federal funds rate again by say 25 basis points or 1/4%, then that could mean the stock market will go down again. Because typically when the Fed raises rates, the market goes down. Now, that could be good for investors, right, who are looking to buy things on sale and get discounts, right? But it could spell a lot of problems for people that are actually relying on the money they have invested to say live, to say pay their bills, right? When you see your portfolio shrink from $500,000 to $300,000 and you're 70 years old or you're 65 years old and you're trying to pay your bills, that can be scary. So what the Fed decides to do with rates upcoming is going to be huge. Now, right now, guys, the odds are 35% that the Fed will actually increase the federal funds rate again by 1/4 percentage point or 25 basis points. Now, in my opinion, I believe they will. That's my personal opinion. And I say that, guys, because looking at all of what was said in the meeting minutes, all of the tone of what was said, what they're preparing for, I believe that they're looking to continue their policy that they have been doing, which is raising the federal funds rate. None of this is a guarantee. They don't know exactly what's going to happen. There could be things that they're not considering as heavily right now that could happen in the next couple of months that could totally change their projections or totally change the way they're looking at this thing. But based on what I've seen, guys, I believe that they're probably going to raise these rates again one more time before they may consider a pause after that. So in my opinion, guys, as long as inflation remains sticky like it has been and continues on this slow downward trajectory, the Fed is going to likely continue doing what they've been doing, raising the federal funds rate. Now, listen, I could be completely wrong about this. It's just my opinion. We shall see. I encourage you guys to go out and check out these meeting minutes for yourself. There's very interesting stuff, guys, that you won't really see on TV or in social media that's talked about in those meeting minutes. Or you could always just continue to watch this channel where I try to break this stuff down to you guys in plain, easy to understand language. Hey, thanks for tuning in, guys. If you got anything of value out of this quick video, smash that like button for me. And also please consider subscribing if you're not already a subscriber and hit that notification bell so you'll be alerted every time I do a video. Until we talk again on the next video, guys, peace.